My name is Ben. I'm the Chief Investment Officer here at Aperim Advisors. We're very similar to Alex in how we set up. We're about $800 million in assets. And so between Alex in Seattle, myself here in Orange County, and Gina down in San Diego, we have all the West Coast covered. I think when I talk to clients and when my advisors are talking to me and asking about what they're talking about, I really want to summarize it into two areas, right? Either clients 70% of our clients are retirees, right? So either clients need cash flow from the portfolios to help them retirement, or number two, especially with our older clients have lived through the late 70s and the early 80s, know who Paul Volcker is. They will remember the days of high inflation. So that's really where those two main concerns are coming from for a lot of our clients. And it's great to we have a whole gamut of people to talk about what their opportunities are like. So Lisa, tell me a little bit about what you guys are doing at Group RMC in terms of how to address those kind of client questions.
So a couple of reasons. I mean, first, they're obviously uncorrelated to the market and provide strong cash flows, as you mentioned. In our case, a lot of advisors use our co-investment opportunities for income needs through capital appreciation and steady cash flows. Many of our investors also like the long-term nature of our investment strategy. So contrary to a lot of other real estate groups, we actually don't hold ourselves to a prescribed holding period. We will sell when the right offer comes along, but we don't want to be in the position that we buy a lot of our assets from, forced sellers, end of life of their funds, need to dispose of an asset. And obviously, when you're in that position, you might not get the best pricing for it. Who's to say, if you have to sell during COVID, for example, that's not a great time to sell. Also diversification, whether it be diversifying from other asset classes that an investor has, whether you just want to be in a multi-tenanted office building, or geographic diversification. That's a feature that a lot of advisors like about our co-investments.
Gina, Alex, are you guys using any, private real estate deals like what Lisa has? Or?
Yeah, I see being able to offer them 4 or 5 different options, and we might start our own fund, and then, as Lisa said, they can co-invest or invest outside of the fund if they want to put more of their money directly into that investment as well.
I can jump in here too and just say currently we are not investing in private real estate. We in our portfolios, we generally have used more liquid vehicles. So we have publicly traded REITs for a small portion of the portfolios for clients as part of our equity allocation.
I mean, that's a great point, because we really feel the same way you do, or we operate the same way you do, right? We do a lot more public stuff than private stuff.
Yeah, I think it's really important to find the right vehicle to use to access, the different asset classes for, each of our clients, because there is, you really don't, if you're going to put a client in something that's, more private or less liquid, I mean, you can't really have them changing their mind, right away or down the road in the near term. So I think that's one thing that we're taking a close look at, how we're, putting together different investment alternatives for client to offer different types of clients based on their needs, their liquidity needs, as well as their kind of overall understanding of the liquidity and the asset class in general. So with a wide range of clients, which I'm sure you guys have as advisors, you really need to have different opportunities for different types of clients. So
yeah, definitely. Lisa, with your firm, do you guys care what part of the cap structure you're investing in? I mean, are you pretty much real estate equity people only? Are you looking at the debt or the mezz side of stuff? Because I do have the thing, when you look at the news reports, you do see what's happening out there in a post-COVID world, especially with hospitality and leisure. Are there opportunities not only on the equity side, but also on the debt side too?
That's a great question. We're focused on the equity side for the time being. We're finding really attractive buying opportunities from just simply distressed sellers, people who, put things on the market last year, had sales processes that were completely steamrolled by the onset of COVID. Buyers backed out and they need to dispose of these assets. And we're buying them at 20+ discounts to pre-COVID pricing and 70 and 80% discounts to replacement costs. So the cost to construct the building today. So, I mean, it's a really, really exciting buying opportunity and time. And also, I think what's interesting is the shift that we're seeing from gateway cities. We've always been focused in the secondary and tertiary markets in the Midwest and Southeast parts of the US. That's just where we've been finding opportunities for the past decade plus. And it just so happens that now there's even more momentum going into these markets.
Ted, Tell me a little bit about Center Square and what you guys are seeing out there in terms of global listed infrastructure.
Typically speaking, what infrastructure does, listed or private, is it provides a source of extremely stable cash flows across the economic cycle by nature of the assets themselves. So you're talking about the provision of essential goods and services, whose demand tends to be either relatively or highly inelastic in spite of recessions, growth periods, things like that. All of that is true unless you have a global health crisis that keeps people locked into their homes and no one goes to travel. There probably is not a set of assets, and this is a group that is comprised largely of, you're talking about utility assets and toll roads and airports and cell towers and things like that. There's probably not a better set of assets that are exposed to the global decarbonization trend that's impacting markets right now. And so as government policy gets put into place, as investor preferences continue to mature and look at ESG and ESG related factors more closely in their investing landscape, the attractiveness of the assets, I think, becomes more interesting and more in demand.
Yeah.
So that's still on the come, but I think there's an extremely attractive secular backdrop for the group. And that's probably one of the reasons why you're seeing demand for it right now.
Well, I remember probably, I should say a few years ago, probably about 15 years ago now. So I guess that's a few years ago. There's a big trend with Harvard and Yale and the endowment approach to investing, and this was investing in infrastructure. These are long-lived assets, they're great cash flow businesses. I think in many cases there's a huge constraint to, you're not going to build more airports or more power plants. They shut the one down between Gene and I down, right? And the San Jose nuclear power plant, they just shut that down. So I think it does hit a lot of trends that investors really want to see and investors are really asking for. I have to ask, Gina, Alex, what are you guys doing here in this kind of space?
I can jump in here. Yeah, I kind of alluded to it before, but we have a mix. We're accessing the space using an interval fund currently. So under the hood of that interval fund, we're have exposure to a good amount of infrastructure on the both private and public side. So you do have, it meets liquidity needs in terms of being accessible quarterly, but also getting access to some of the private exposure as well to keep that stable income and provide higher expected returns from the private side as well. So it's we felt like it's a good kind of mix there and a way to kind of access that infrastructure super cycle that is potentially forming here for the next few decades. So it's that's currently how we've been accessing it, but it is a fairly newer area for us as well. So we a continued area of interest and focus for us looking forward.
And for us, we don't have a private, we haven't invested privately in infrastructure, but it's definitely we have listed public equities that are definitely active and geared to that sector. So far, that's what we've done there, is just staying with the listed companies that we own.
Ted, where are you seeing the opportunities right now, really, in this kind of space, right? If we're to invest in this, we're not investing in one deal or one pipeline or utility company, we're investing in the fund. How are you allocating capital? Same question here, which I think I know the answer to already. What you asked Lisa, are you talking more about, you're talking about listed equity, right? So you're not going to talk about the debt side of things. So just equity, right?
Yeah. So first, yes, liquid equity, not debt. And then secondly, the answer to your question about the attractiveness, I think, has two dimensions to it. The short term, sort of tactical, there, I think you have to look at areas like airports and toll roads that have taken an absolute beating from a 70-80% drop off in volumes. Airports, that's generally speaking the number at airports right now globally, which is sort of staggering. And so as that comes back over the next, let's call it 12 to 18 or 12 to 24 months, those companies are going to look like ridiculous growth engines relative to what they customarily are. And I think that's going to continue to attract capital here. And so those companies look poised to me to be big outperformers relative to global markets. Longer term, I think the answer longer term really lies in the build out of renewable generation sources to sort of fuel the global economy over the next 10 to 20 years. The economics of those assets have gotten increasingly better to the point where now over the last 3-4 years, they're economic without tax subsidies and support in a lot of places around the world. The offshore wind potential in the United States is just beginning to be tapped. In the rest of the world, it's moving down that path, but it's still really in very much the early days. So I think the story over the next 10 years is the increasing change in the way that we sort of produce energy for each other and what that's going to mean for investment. And from where we sit, the ability to invest in that in a diversified way, particularly across a lot of regulated frameworks where I don't have to worry about being disintermediated, or if I were to look at, and I don't want to pick on Tesla by any stretch, right? But if I were to pick on them because they're obviously much more component material kind of, consumer oriented, the risk to that obviously is someone can come along and find a cheaper way to make a very attractive looking vehicle that does a lot of the same technological things, maybe. And that's a risk from a competitive standpoint. When you build, a wind turbine and put it into a rate base that's going to be depreciated over 10 years and you have a contract to get paid for it, that's a very different risk profile. And so on a risk adjusted basis, it's an extremely attractive set of cash flows. That's where we think the long-term opportunity is really compelling.
Interesting. Wow, that makes a great case for it. By far, the most questions I get as an advisor in the last year or so, it's not Tesla, it's not Netflix and Bitcoin. It is clearly gold. It's clearly precious metals, to a certain degree, silver and the miners out there. It was a hot button 10 years ago when the Fed started QE. How are you seeing advisors use them and use gold and precious metals in client portfolios?
Yeah, it's really interesting. Gold has been a really interesting asset for about the last 2+ decades now. And it really goes to what you just said. It's really a monetary metal. Silver is probably more of a hybrid metal, more of a trading metal, more of a retail metal. But gold's been really interesting. Gold's been one of the better performing assets for 2+ decades now, because we've entered this kind of modern monetary theory and QE process and printing and lower for longer interest rates. All those things are driving the market. Everyone started focusing on precious metals this year in particular because of COVID. But the reality is, if you look at what gold's been doing from really 2000 to 2011, with it really being turbocharged from 2008 to 2011, and then more recently in the fourth quarter of 2015, when the Fed attempted to tighten, the market woke back up to the gold trade, particularly the physical trade. And in the first half of 16, physical is up over 20% and equities are up over 100%. And since then, gold's been sort of clipping off about a 10% coupon every single year, because we all realize it's going to be very difficult to raise rates anytime soon. So the opportunity cost of owning gold relative to bonds is relatively zero. When you look at it from a risk standpoint, from an opportunity standpoint, then when you translation to the miners, the profitability of these miners then, with gold sitting at 1850 to 1950 range right now, is very profitable. A typical mining company is pulling gold, silver, platinum, palladium, copper out of the ground, at relatively low multiples right now. In fact, if you think about just gold in general, depending on where the mine is located, if it's open pit or closed pit and so forth, you're looking at $900 to about $1,100 an ounce. So even if gold were to sell off 10 or 15%, a lot of these gold equities now are very profitable. They're increasing free cash flow. They've expanded their economic moats because there hasn't been a lot of new discoveries. There hasn't been a lot of CapEx since 2011 in the gold mining space. And so there's a transitioning happening right now where the last 4 or 5 years, investors have been predominantly using physical metal as a hedge or a complement to their equity portfolios, but also as a replacement to their bonds, and for our international investors as part of their cash portfolio. That's starting to change now. The market is now starting to shift gears and look at the gold equities, with gold equities paying dividends in some cases, with the M&A market picking up quite nicely, with the average lifespan of mines going from about 16 years in 2011 to about 9 or 10 years today. You're seeing M&A, you're seeing free cash flow, you're seeing dividends, you're seeing gold mining stocks that look like other stocks. It's no secret Buffett bought Barrick this year. And they're starting to look at these companies also for the first time. In fact, it's always funny because usually in the first sentence or two of the first chapter of Buffett's annual letter, he talks down gold. So I think it's kind of interesting as we're starting to think about gold for the first time. So I think we're in the early stages of what we think is a 3 to 5 year cycle, particularly for the gold equities, but also for physical gold because of what you mentioned earlier, because of quantitative easing, lower for longer interest rates, and so forth.
Well, I'm going to stop you there real fast. You just said 3 to 5 years, which is kind of counter to what I've been learning about gold and precious metals in general, right? But the super cycle that we have in commodities. So are you saying that there's not really a super cycle in these precious metals? There might be, I'm not talking about super cycles in oil and industrial metals, but how about precious metals? You don't think that's the case?
The super cycle in earnest started in really early 2000s. In fact, if you think about gold as an investment, prior to funds that were ETFs out there that came out in early 2000, 2003 was the first ETF that came out that allowed you to get exposure to spot price, not own it, but get exposure to spot price. Prior to that, it was very difficult to allocate the physical metals, right? So you had to play the equity game. If you wanted to own physical metals, it was really for the high net worth individual, the private family, the big institutions, the universities, the endowments. But in the last 2 decades, physical gold has become a much more liquid solution. At Sprott, we have a unique ETF, or it's actually a closed-end fund that allows the client to actually own the physical metal, but in an exchange-traded way and in a tax-advantaged way for a U.S. investor. But what's unique is that the last 2 decades, you've really seen gold start to gain traction, and it has been in that super cycle, largely because it's more accessible, and largely because of what we've been doing with QE1, QE2, QE infinity, printing up money. Now we're in modern monetary theory. We're poking the bear in a lot of different ways right now with what we're doing. Some of it necessary, some of it probably a little too aggressive. But gold is starting to move itself out of the commodity basket and into the alternative asset basket. And that's where we see most advisors today using precious metals or using physical gold in general, is as an alternative, not as a commodity play, but as an alternative asset play.
Oh, wow. I mean, yeah, it's definitely an interesting time. Last couple of years in gold, you've really seen a big move up, and I think the COVID situation really accelerated that. But yeah, it's crazy how some of these miners went from big destructors of capitals to big generators of capital now, and their fortunes are changing.
It happened pretty quickly, yeah.
Yeah, very kind of like banks, huh? Alex, Gina, I mean, I have to ask, what are you guys doing in this space? I mean, certainly I cannot be the only person getting questions on gold, public infrastructure, and real estate, right? What are you guys thinking out there?
Equities, and I'm very comfortable with that. I've never personally in my career owned physical gold, so that's something we haven't done. Not to say that we wouldn't do it, but right now we're very comfortable with our gold equities. And as you say, they went from pretty expensive stocks to pretty cheap stocks, even though the stocks have gone up. So I mean, the earnings and the revenues have been growing along with the price of gold. So we're going to continue to own gold equities, but don't own physical gold for this time. And yes, we do get asked about it. Absolutely.
We get asked about it as well. But we've tended to own, our equities are probably more broad as opposed to kind of sector focused. So we've historically kind of been there in terms of exposure to, we've taken more broad exposure to commodities in general through like a managed futures, trend following exposure on the future side. So it's more not direct in equities or in physical gold necessarily. So, that's just what we've done in the past. Never say never in terms of what we're going to invest in looking forward, but it sounds like there are some different, and especially tax efficiency is really important from our perspective in terms of accessing different markets. I think that's something that, ETFs and other, investments can be useful there, because that would be something we would always look toward in terms of tax efficiency and just cost in general. So,
and scalability too, just from an investment management standpoint, right? Making sure the first client is the same, make sure that the thousandth client is the same thing as the first client, right? And so that's a huge thing too, especially with some of these private deals too. When we value a company, we pay particularly close attention to operating margins, cash flows, free cash flow, everything that we learn about in the CFA, and you don't really get that with the physical gold, right? You can value Barrick and Glencore even to a certain degree, just using DCF, right? But you can't really do that for physical gold. So why would you own? When do you think is an appropriate time to own physical gold versus some of these gold miners? Is it truly the inflation hedge that everyone talks about?
Well, the inflation or deflation, or stagflation, gold, I always joke with people, gold's not a trained seal. It doesn't perform a certain way when something else happens.
Yeah.
So it can be highly correlated to the market because you're seeing other parts of the world like India and China do better. And so they're spending more money. And it could have a low correlation to the market when people are using it as a flight to safety. So you really have to look at the reasons behind why you'd want to own physical gold versus gold equity. They're really two separate categories in a lot of ways. We always say really physical first, and we say physical first is a way to disrupt the 60-40 type of model. And you look at gold as a hedge to your equity portfolios. And what I like to tell people is that physical gold is not designed to replace your traditional stock allocation. It's actually designed to allow you to stay invested in your traditional stock allocation. Because when you look at physical gold over multiple market cycles, its performance pattern is very different than the traditional markets. The equity market's more of a risk-on type of trade. It is an equity. It's got management. It's got balance sheets. It's got debt. It's got cost. It's no different than any other stock out there, except for one thing: its primary product is pulling a metal out of the ground, and so you have an additional opportunity or an additional volatility when you think about gold equities, because you have to factor in the price of the physical metal itself that they're pulling out of the ground to dictate their margin expansion or contraction. So they're very different. You have to think about them differently. You have to ask yourself why you're allocating to the space. If you're looking at purely as a natural hedge, we would make the argument to go into the physical. If you want to be more opportunistic about the allocation, then we would talk about the equity side of the trade.
Awesome. Yeah, they're two very distinct things, even though they're kind of the same. Some people kind of lump them together. Let's talk about how you guys think about using in the future, right? What do you two want to lead your firms going forward in terms of your investment management strategies? Do you think these are solutions that we should, as fiduciaries, I think we're all fiduciaries, that we should be looking forward to provide these solutions to clients, given where rates are now, where the dollar is now, and what we have to look forward to? Is that where you want to take your firms?
Well, yeah, I definitely, I look at everything on a relative value basis. Gold can be looked at on a relative value basis versus different commodities versus the stock market, things like that. Obviously, I think a lot of people are having trouble finding value in fixed income. There's not a lot of value in fixed income. So we're trying to work that down and saying, what else can we, what are the other investments we could do? Alternatives are going to be part of that. Gold an alternative, possibly owning physical gold could be an alternative.
Yeah, I would agree with Alex in the sense that looking forward, we're really trying to make asset class decisions based on valuations today. That a lot of, large cap, tech companies, as we've seen this year, have really pushed up in terms of valuation. So it's, want to take those valuations and factor that into our forward thinking and what our expectations are for asset class returns.
Where are people taking that money to allocate to real estate and infrastructure? Are they taking it from the fixed income sleeve because it's yielding nothing, or are they taking it more from the risk sleeve on the equity side, or both?
We're taking ours to fixed income.
We have similar approach from our end as well, just given that those your expectations.
We've done it a little bit in the past at APRIAM, not a lot in the past 10 years. We do get a lot of questions about everything that you all are talking about. And I do really appreciate the fact in the last 15 years or so, there has been such a big shift and big flow of capital towards these kind of products, right? And for example, in terms of physical gold, like before you had to buy futures, right, to get gold exposure. Now you can get spot gold very efficiently in an exchange traded fund. Infrastructure was always a finicky thing to get exposure to. Now you can get it in a listed, you can get listed infrastructure in a mutual fund or a 40 Act fund or a separate account. And then real estate, right? Real estate's always been one of the toughest things. Do you really want the public route or the private side? And there's always been a misalignment in terms of interest and fees. And it's really interesting and really awesome that so many advisors like Group RCM are coming down with products that are aligning the interest. They're aligning their fees with our clients' interest and getting the commissions out of the way, not avoiding the whole selling agreement and BD kind of affiliations there. So I do have to think that in the next 10 years, this is something that we're looking forward to at Aprium, seeing what we can do for client portfolios and coming up with solutions to really manage their cash flows and what they need.